Welcome to This Explainer. Today, we're going to break down the massive financial shifts we saw in March 2026. We're going to take all those high-level global disruptions you've been hearing about and synthesize exactly how they trickle down to, well, impact your very own pocket. So let's get right into it.
But before we map it all out, you really have to ask yourself a somewhat crazy question. What on earth connects global oil prices, mutual fund overlaps, and a strict 5-day deadline to save your bank account? I know, it sounds completely unrelated, but as we go through this explainer, you're going to see just how intricately tied the massive global economy is to your personal, everyday financial security.
Okay, so here's our roadmap for today. We'll be tracking the ripple effect, starting with macro shocks and market drops. Then we'll look at tightening the lending ecosystem, move on to how SEBI cleans up the markets, and finally, protecting the everyday consumer. All right, starting out wide with Section 1, macro shocks and market drops. We're going to examine how geopolitical tensions over in West Asia are aggressively testing India's economic resilience. The absolutely crucial point here is the Indian rupee tumbling to a fresh all-time low of 92.63 per US dollar. And this wasn't just some isolated event out of nowhere. It was heavily pressured by continuous foreign portfolio investor outflows and, of course, soaring global energy costs tied directly to the crisis in West Asia. It was wild. Importers were basically scrambling for dollars, while exporters actually left themselves exposed without financial hedges. The whole situation ended up pushing the currency down over 8% for the fiscal year.
And the resulting chaos on the ground? It was immediate. Indian equities faced severe selling pressure, totally snapping a 3-day winning streak. Just look at the numbers. We saw the Sensex and the Nifty both plunge over 3.2% in a single day. A huge driver behind this massive drop was Brent crude. It spiked by nearly $12, hitting a 4-year high of $119.13 a barrel. And because of all these global risk factors, the India Volatility Index, which people often call the market's fear gauge, well, that shot up nearly 22%.
So, to defend the rupee from all this external chaos, the Reserve Bank of India had to step in. They actually replaced their previous flexible framework and imposed a really strict cap on banks' net open position. You can think of this kind of like a daily spending limit for the banks. By capping this at $100 million at the end of each trading day, the RBI is actively curbing excessive speculation in the currency markets. It's basically their way of hitting the brakes to stabilize the rupee. Meanwhile, the government itself realized it needed a massive safety net to manage its own cash flow mismatches during this incredibly turbulent period. So, what did they do? They set their short-term borrowing limit for the first half of the 2026-2027 financial year, that's from April to September, at an absolutely immense 250,000 crore rupees. Now, this government borrowing uses something called Ways and Means Advances, or WMA. Honestly, it's easiest to think of it as a giant temporary credit card for the government. It helps them bridge the gap between the money coming in and the money going out. The interest rate on this giant credit card is tied directly to the repo rate. And just like you or me, if they exceed their limit, they face a pretty steep overdraft penalty. On the business side, to shield everyday exporters from external shocks, especially those severe logistics delays happening in the Red Sea, the RBI is actually vastly extending their credit lifelines. This applies to both pre-shipment and post-shipment credit. They've pushed the maximum tenure for these export credit loans way up, from 270 days to a full 450 days. That gives businesses some absolutely crucial breathing room to survive those massive shipping delays. In anchoring all this macro volatility we just talked about, the government has officially decided to hold the line. They are firmly retaining their strict 4% inflation target for the next 5 years, stretching all the way to March 2031. They do have a tolerance band of plus or minus 2%, but this essentially signals that despite those surging oil prices and the rapid currency depreciation, maintaining long-term price stability remains their absolute #1 priority. Okay, moving right along to Section 2, tightening the lending ecosystem. Here we're going to see how regulators are actively trying to cool down some seriously overheated borrowing happening within the country. We are literally seeing explosive growth in this space. Non-banking financial companies, or NBFCs, now command a staggering 83% of the consumer durable loan market. That is up from 70% just a few short years ago. By really leveraging things like fast digital onboarding and smart merchant partnerships, they are completely eating the market share of traditional private banks. In fact, those private banks have shrunk to just 14% of the market and are now frantically pivoting toward fee-based income instead of traditional unsecured lending. Now, because of this incredibly aggressive lending, early-stage delinquencies in the NBFC sector are starting to creep up. So, the RBI is stepping in again. They're forcing NBFCs to shift their credit bureau reporting from the old fortnightly cycle to a much, much faster weekly reporting cycle. The whole idea here is to close that information gap. It's meant to prevent a risky borrower who may be just defaulted from running out and rapidly securing multiple new loans from totally different lenders at the exact same time. Along those same lines, the RBI has also severely tightened project finance rules, particularly for the real estate and infrastructure sectors. The new rules mandate that the debt-to-equity ratio has to remain constant throughout the entire project. And this is a big one. Top-up loans are now outright banned mid-project. The goal here is pretty simple, actually. They want to ensure developers maintain real skin in the game and don't just walk away when funds start getting tight. Ultimately, that's going to reduce intercreditor disputes and those agonizing project delays. Which brings us to the capital markets in Section 3, SEBI cleans up the markets, where we'll look at how they're enforcing transparency and fair play. So, to protect everyday investors, SEBI has mandated a strict 50% portfolio overlap cap. This is targeted directly at mutual funds, especially those super trendy ESG, business cycle, and thematic funds. The data was showing that these funds were marketing themselves as totally distinct products, but behind the scenes, they were just buying the exact same stocks, like Infosys or HDFC Bank. This new cap basically ensures they aren't just selling you the exact same underlying stocks, but wrapped up in a different name and charging you for it. In a totally separate crackdown, SEBI penalized 18 individuals linked to the Choksi Group. These folks were maliciously manipulating an illiquid stock called Retro Green Revolution. How? By using deceptive Telegram tips to artificially inflate the share prices. SEBI didn't just ban them from the markets. They actually demanded they disgorge or pay back 2.94 crore rupees in illegal profits. It definitely sends a really strong message against premeditated market fraud. But, regulators aren't just out there cracking the whip. They are also making market access a bit easier and fairer. Over in Gift City, the IFSCA slashed retail and ETF filing fees by 33%. That's a huge move to encourage participation and reduce compliance costs. Meanwhile, SEBI is thoughtfully proposing to relax power of attorney rules for physically incapacitated investors. They're really aiming to simplify inheritance and account management processes that honestly had just become way too complex over the years. Finally, let's transition from those high-level institutions straight down to your wallet in Section 4, protecting the everyday consumer. This is a big one for sure. The RBI is introducing some urgent new digital fraud compensation rules. If you ever fall victim to an electronic banking scam, the clock starts ticking immediately. You must report it to the National Cybercrime Portal or call the 1930 helpline within 5 calendar days. If you do that in time, the bank is actually obligated to credit up to 25,000 rupees in compensation directly to your account within the following 5 days. It's a real lifesaver, but you have to act fast. Now, to stop those scams before they even start, SEBI is rolling out a verified app label on platforms like the Google Play and Apple App Stores. It uses a really simple check, validate, and verify framework. You can now actually validate authentic SEBI-registered apps just by looking for specific UPI handle suffixes. So you'd look for .brk for brokers and .mf for mutual funds. It's a great little trick to ensure you never accidentally download one of those malicious, cloned trading apps. And to help cut down on everyday bureaucratic friction, the National Housing Bank just launched a fully digital Gru Sugam housing loan portal. It's specifically aimed at defense personnel and government employees to streamline their loans. And this is happening right as the Finance Ministry kicks off its Paramba 2026 campaign. That's a massive digital awareness drive that actually uses AI tools to help demystify the brand new and thankfully simplified Income Tax Act of 2025. So, as UPI's explosive growth finally begins to stabilize into single digits and the whole ecosystem faces the long, hard road to hitting 1 billion users over the next decade, we want to leave you with this thought to ponder. From global oil shocks testing our markets to strict new lending caps, all the way down to rapid fraud compensation rules, how will these sweeping new regulatory guardrails actually protect and shape your digital financial future? Thank you so much for joining this explainer, and keep learning.